Hi guys, Peter Mills, Fire Retire Agency. Also the website fireretire.com is how you can reach me. I'm going to do a quick high-level overview. Some of the things you may not know here, some of the things you need to know here. And I'm going to be basically speaking to other firefighters and then police officers who have the same retirement plan as our 457 deferred comp. I just want to make you aware, if you're not, and educate you on the way the taxes work on those kind of accounts. So I made a little chart here, and I'm going to try to go quickly because you probably have most of this information. So everybody knows that there's three main categories when you have retirement accounts: tax now, tax later, and tax exempt. So tax now, maybe you have a little bit of money in there, say savings, liquid assets. Okay, it's good to always have an emergency fund of about 3 to 6 months of living expenses in case you get hurt, off duty or whatnot, and you don't have AFLAC, those kind of things. So it's good to have those kind of a little bit of assets in here, but you generally don't make much money. You can in the last two bonds and stocks, depending on your rates and who you're managing your money with, but generally your money on this side flatlines or goes down because of the two main things there, which is inflation and cost of living. Okay, so putting your money, some people stash their money in a mattress because they don't trust banks. You're just not gaining any money in there. You're not really making money. Okay, there's other things in there, but I don't have time to go into all real estate, metals, whatever you want. So the main category which people use retirement accounts are in the tax to later category. All of these, the 401, 403s, CalPERS, all those, but we have a 457 which is in that category. Now their money in the stock market is tied to this roller coaster, up and down, up and down. Your money is at 100% risk in these kind of accounts. Every 8 to 9 years since 9/11, we've had a reset that's been very bad, a crash in the economy. That's why people like Warren Buffett and Bill Gates have taken cash, liquid assets out of the stock market over the last year or so and held them somewhere else so that when everything crashes, they can buy everything up at cheap prices. They've taken their money out of the stock market. So here's some rules that apply to age in this taxed later category. So our deferred comp, they say it's the greatest thing out there because you're not going to be taxed now. You can put a ton of money in there. You can put all this money in pre-tax, so you're putting in more money. And then later on, you're going to have a lower tax bracket. So when you pay your taxes eventually, it's going to be less. Well, that's not accurate, period. Because your federal and state taxes, unless you move out of state, it'll be a little bit less, but they're going to be about the same because your pension, our pension, puts us in almost the top bracket for taxes. The next caveat is, at this age, while we're still working, we probably are paying our mortgage, so we have some mortgage interest we can write off. Also, we may have dependents living in the house that we can write off and have certain deductions for. At age 50 to 60, we're probably going to have our house paid off, and we're probably not going to have dependents. The kids are probably have moved out of the house. So you don't have these shields that they say is going to be so good about our deferred comp of being taxed later. And you're going to be hit the hardest. But let me go over the ages for you, okay, if you're not aware. So for us, it's actually age 55. So age 55 years old, if you retire and start using your deferred comp money before age 55, you will be charged your state and federal tax plus a 10% penalty on your own money. 10% penalty for taking out your money before 55. Okay, between 55 and 70 and a half years old, you just take your federal and state tax hit, 35%. No big deal, right? You've given that money the whole time, and now you're going to take a third of it, a third of a hit, the whole. Okay, good, great. Now after 70, you're going to be hit with a 50% flat tax rate. So at age 71, and you got 300,000 or 400,000 left, and you're great. You're using your pension. You just use deferred comp here and there for a little bit, maybe a trip or two or something like that. You're going to get a 50% hit tax on that, period. Now there are things you can do with your deferred comp before that, but that's later. That's right before you retire. If you're near retirement and you don't have someone you're talking to, I would love to be someone that you could talk to about this. Okay. The last category. Oh, and in this category, they get paid whether you win or lose, whether you make money or not. You're going to go up and down, up and down, up and down, and you're going to be paying fees and money, marketing, management fees the entire time. Okay. So the problem's there. Okay, now the third category is called tax exempt. This category was created by rich people, politicians, ultra wealthy, because they have all the attorneys that can write this into the tax code, and they never break these two rules. Lose no money and pay the least amount of taxes legally that you have to pay. Those are their two main rules. Now they have people putting their money everywhere and whatnot, but this one is the no-brainer. Okay, for example, Kobe Bryant puts over 30 grand a month into his tax-exempt retirement account. He doesn't use these. He uses these. Okay, so the way these are set up, you can have them set at a fixed rate of return, say between 4 and 7.75% interest. You can have it set so that's what your money looks like. It continually gains only. You can't lose. Guaranteed in writing, you cannot lose money. Another way is a lot of guys that I've talked to that are still going to be contributing for the next, they still have 10, 15, 20 years on the job. I put them into a program like this where they have a floor of 0.75% up to 15%. Historically, it's done 9.75 over 20 years on the average. So they can never lose money and they can only gain. Okay? So your money is safe and protected. Now again, this is the tax exempt, so you never pay taxes on it again. What you have in here is 100% yours. Okay. Now these have other benefits. You can get, as I said, guaranteed rates of returns. You can get guaranteed income for life. What did I write there? Oh, it doesn't pass through probate. So here, when we die, when we pass, we're going to be able to transfer whatever's left in, say, our deferred comp over to our family. Now, if you have a trust or a will set up, it does help, but it still has to pass through some entity, such as a judge, probate, or estate, and they may take a fee, a tax out of it. Okay? This side does not. The instrument itself, the way the policies are written, the way the accounts are set up, it already is dispersed tax-free to who you designate as beneficiaries, just as you designate a beneficiary over here. This way, it doesn't have to pass through an entity. As I said, think about who created them. Rich people and politicians. They're not going to let a judge try to decide what goes to their family. Over here, where they shove the masses, you have to bend to their will. They're going to get their money however they want, whenever, while you're alive or when you die. They're going to get their money. Okay. So on this side here, this is potentially on the chopping block. If a company goes bankrupt, a city, state, whatever goes bankrupt, taking cuts, potentially you can lose your deferred comp, your drop, your pension. They're all in this category. This category you cannot, they're protected. The government can't touch it, the IRS can't touch it. Can't be used that way. Say you do accidentally do something wrong, you get a felony and you go to jail or something like that. Seized, suspended, taken by the government. This side they cannot. Okay? So what I propose is instead of dumping pre-tax money into here and wait, loss, win, fee, I'm retired, where's my money? Oh, I'll take a 30% to 50% hit. I don't want to play that. I say take your money now that's taxed, don't put it in here, so take what you want. So if some people are maxing out their deferred comp at whatever, $800 a check, $1,600 a month, let's say it's $1,500 a month. I would say don't put it in there. Just make it now $800, $600 a month after tax and put that in here. I've run several calculations where $600 and up, $600 to $800 a month, and you have another 10 years or so on the job, you will beat this because you take no losses and you do not pay taxes ever again. So $300,000-$400,000 in here is exactly $300,000-$400,000 in here, tax-free. $300,000 in your 457 deferred comp is anywhere from 30 to 50% gone due to taxes. When you need it most, you could be 72, retired for several years, a couple decades hopefully, and oh, by the way, your money is only worth half of that. I'm not going to play that. So there's some info for you. If there was new information, if there was better information, I think you should at least know about it. Anyway, again, my name is Peter Mills, Fire Retire Agency, fireretire.com. Have a good day. God bless.